France, and Italy, plus a host of smaller economies like Estonia and Malta. You can buy foreign currencies just like you can buy foreign cars, and just like the price of foreign cars, the price of foreign currencies varies. People usually use the term exchange rates rather than prices for currencies. Since its inception in the late 20th century, the dollar-euro exchange rate has fluctuated from a low of around 0.85 to 1 to a high of around 1.6 to 1. Put differently, you could buy a euro for 85 cents in late 2000, but it would have cost you about $1.60 for that same euro in late 2008. In practical terms, that variation can affect U.S. stock prices. A BMW that cost 40,000 euros in 2000 would have cost you about $34,000. A BMW costing 40,000 euros in 2008 would have cost you almost double that, $64,000. Fluctuations like that can obviously affect a company's sales and profits. Determining how they affect sales and profits isn't as easy as it looks. A lot's going on behind the curtain. For one thing, BMW has to buy the components and parts for its cars. If the euro is strong, then it can buy those components and parts for less. That will either boost BMW's profits or let it lower its prices. After all, it's competing with Mercedes, and Mercedes is in the same position, so maybe that car that cost 40,000 euros before won't cost 40,000 euros now. Projecting sales and profits gets complicated fast. These days you can buy a BMW built in the United States, so the exchange rate doesn't matter as much. Lexus, Acura, and Infiniti are also competing, and the exchange rates between the yen, the euro, and the US dollar are in the equation too. Maybe that's why the link between exchange rates and stock prices isn't as strong as it might first appear. To take the S&P 500 and the US euro exchange rate as one example, you'll find that the S&P rose while the euro fell against the dollar in the late 20th century, and then the exchange rate stayed mostly flat or rose while stocks fell from then until about 2003. In 2003, the two began to move in mostly the same direction until about early 2012, when stocks continued to rise while the euro flattened against the dollar. And that's just one currency, the euro. The relationship between stock prices and foreign currencies is complicated. Using a single currency like the euro in multiple nations has good and bad points, and some of them can affect U.S. stocks. It's nice that a French baker near the border of France and Germany doesn't have to make a lot of transactions in both currencies, for example. Customers living in Germany don't have to worry about whether their German marks will buy the same amount of goods today as they did yesterday. Record keeping and billing are a lot simpler. To get a feel for the disadvantages of a single currency, think of economic problems as infectious diseases. If I live in Germany and you live in the US, then the odds of me spreading my flu virus to people who end up infecting you are a lot lower than they are if you live in, say, France. To infect you, the virus has to make it across the Atlantic from Germany all the way to the US. It can happen, but it's a lot easier for it to spread across a border that saw many thousands of people crossing each way every day. A common currency makes it easier for problems in one country to affect others. Most experts agree that problems in Greece, a relatively small economy compared to Germany and France, contributed to the length and severity of the European recession that began in late 2007. Normally, when a government runs big deficits, its currency falls relative to the currencies of its more frugal neighbors. That's because people understand that in the long run, the government will probably do what governments have done in the past: print more money to cover the bills. Creating more money out of nothing lowers the value of that money. But if one country overspends relative to other countries using the same currency, like the euro, then it can't print more of this common currency. The result is that economic contractions can be worse. That hurts international trade a lot more for countries using the common currency than it does with the United States. Still, the U.S. needs healthy trading partners, and if a huge economic area like the Eurozone coughs, then the entire world catches a cold. Sometime during the next few days, take a couple of minutes and go to the Fed websites and look for articles and data that catch your fancy. The National Bureau of Economic Research, or NBER, also has a good site, although sometimes that information on it is very technical. You can find a lot of information about currency trading and exchange rates online too. You'll find historical exchange rates, current exchange rates, average exchange rates for dozens of currencies over any number of different time periods, graphs, and news articles. In our next and final lecture, we'll look at some things you might want to do to make sure that you're comfortable with your decision to invest in stocks. It's time to take a closer look at your financial situation and decide what you want to do.